What does a good buyer's agent look like, and what are the questions you need to be asking them? Hi, I'm Jaryd Krause. I'm the co-host of Property Pals Australia.
And I'm Sam Powell, the other guy. And in this episode, we get to talk to the lovely Joe Tucker, who's the director of Property Principles Buyers Agency. And he's also the co-host of Oz Property Investors, along with Jeff Miles, which is close to 80,000 subscribers at the moment. Really great community. And yeah, we have a really in-depth chat about, what to be looking for in the current market, and how there is a constant change of flux happening as investors, and why it's important to stay on top of the game.
Yeah, we also talk about the difference between like long-term investing, short-term investing, opportunity costs, how to build out a portfolio. When is the right time to actually move from, say, residential property to commercial property, which is fascinating. It's not based on how many properties you have or the valuation of your property portfolio, but more of a personal thing and something that you really need to tune into, and then start asking yourself a bunch of questions around as well. This is such a valuable podcast episode. We talk about like where people stuff up, how to freeze capital in property and take those returns later, capital growth versus income straight away based on the current market. It's an in-depth episode on all things property, and I'm sure you're going to absolutely love it. Make sure you just also, if you want to increase your borrowing capacity, get our mini course on how to, get a higher borrowing capacity. You can head to our site, propertypals.au/resources. But for now, jump in and enjoy. Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jaryd, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional.
Welcome back to Property Pals Australia. We have the lovely Joe Tucker, who's the director and owner of Property Principles Buyers Agency, and also, mates, Oz Property Investors. That's come a long way. What do you got now? How many thousand subscribers?
Co-founder of Oz Property Investors with Jeff Miles. Well, it's the largest now, man. I mean, we've known each other for many, many years. It is the largest in Australia with 78,000 members. By the time this probably gets launched, it'll probably be 80,000. So it's gone absolutely bananas.
Yeah, I've strategically reached out to Jeff individually to get you to silo you two, just to run that. So
he's
looking forward
to a lot of value to add. I mean, this is how it is. Like, this is how the community grew. Everyone's like, "How'd you guys do it? How'd you grow the?" You just give value of like, what are you guys experiencing? What are you guys going through in the property market? And like, it's not all sunshine and rainbows. It's like, great, I just had to crash this deal because the pest and building fell through. This is what I learned. This is why I crashed it. Or yeah, that's cool.
Yeah, that's why I wanted to get you on, because I mean, there's a journey, right? And what you knew in the past, what you know now, would have changed dramatically. And I think it's really come across in everything you've been producing. So you've definitely changed a lot of people's lives with that education.
Yeah, hopefully.
And yeah, that's like, let's just dive straight into what you mentioned, is like you what you learn as you go through it. Like, what are some of the lessons you've learned since starting your buyer's agency? Like maybe it's like 2 or 3 like key ones. They don't need to be extravagant or anything like that. It could be as simple as like what you learned through a building and pest, or why you had to crash a deal, or a client, or whatever it is. But yeah, is there anything that sort of sticks out top of mind?
Well, the big one for me is just dealing with everyday investors, right? Like my demographic of audience is like 550 to $1 million kind of purchase price range. So that's everyday Aussies trying to make something happen. The good thing is that's where a lot of value is right now. So if I was to say like, oh, where do you see the most amount of capital growth? Like in a price range, I'd be saying it'd be like that 600 to 800 range is where you'll probably see the next kind of boom and movement. But 71% of investors never get past their first investment property. And that's purely because they choose the wrong type of deal for them at that point in time, or they mess it up entirely. So what it comes down to is just making sure that you set up a bit of a strategy and a bit of a plan, because like as a property investor, the way maybe this is probably not answering the question directly, but you've got really three resources that you're trying to balance as a property investor. And you don't like, everyone tries to make it more complicated and complex than what it is. But essentially all it is cash and equity on one hand. It's borrowing ability and serviceability, and then portfolio cash flow. And all of those kind of feed into each other. So I guess one of the things any investor needs to ask themselves is, like, what is my limited resource, and what does this next property need to be to allow me to get into the next one? So like if your broker says, I've got $1 million that you've got $1 million to spend. Great. Don't just go out there and buy $1 million property, because it'll probably have a 3.5% yield, which then means that it's going to eat into all your borrowing ability, your serviceability, your capital, and your cash flow. And then you've drained all of those kind of energy bars and you can't go for the next one. So that's probably a big key point, to not overcomplicate it. 3 resources. That's all you got. Balance them out with that next purchase.
I think a lot of people, when they start investing, they have this ideology that because money's been hard to get, it must continue to be hard to get when they start investing. So we overcomplicate. I know that for myself, is like, just got to do everything and try everything and try and make it work, when realistically, like, the richest man in the world, one of the richest, well, used to be, now we've got Elon just crushing it, but like Warren Buffett, he's just like, just wait to find a good business and just buy it. I'm not doing like, trading like the spot prices and differences in stocks and all that sort of shit. It's just like, I've just got one strategy. It works for me. It's boring as F, but like, I do it well and stayed doing it for decades, and that's what you can do in property, right? It's like, but first, if you can't do that if you are trying to make it complicated at the start, which is why buyer's agents are so valuable.
Yeah, that sort of hits home too. Like, you talk about what's your most valuable resource, right? And I've come to realize people and this is I'm classic for it, like, is time. I've undervalued my resource of time, which really is the most valuable resource, because I'm sitting there going, you're penny pinching. I'm that valuer that is always overanalyzing and then not taking action. Try and find that perfect deal. I mean, would that be? That's one of the things I've seen, Joe. Like, is that pretty common in your world?
Yeah. Well, what I see is people. They kind of buy for today and they don't think about the future. So, for instance, what I see, one of the biggest things is people focusing too much on cash flow. Like, they will go out super, and I'm not talking like regional. Regionals have absolutely crushed it, and still will do crush it. So, like, if you're thinking like a Townsville or something, that's one of the hottest markets right now, and I think there's still some good run to go in that market. But you see people like, oh no, I need to have a 7% yield, I need to have an 8% yield, and then they go out in these mining towns and they buy all these things, and it's like, great. Let's just break this down. Let's say you understand that it's not going to have as much capital growth, that area, because the fundamentals aren't there. There's no imbalance of supply and demand. No one wants to actually live there, so there's no demand, and the supply there's farms and farms for it. But if you go ahead and buy something like that, it's just going to ruin your entire portfolio. But what does $100 a week in your back pocket mean to you right now? Like, as someone who has a full-time job that works, it actually doesn't mean anything. Cash flow is the end state. You have to kind of build a portfolio of capital growth first. So as you build up, it is kind of scary to buy that first property. But I see people just they wanting the cash flow first. It doesn't matter. You'll get the cash flow over time, because what would you rather? The question should be, what is this going to look like in 10 years? And if the answer is it's going to be giving me $50 a week for the next 10 years, or it's going to be growing at 8% compounding for the next 10 years, that means you're going to have a $500,000 property that's now a $1.2 million property, or a property that's worth $650,000. Like, that capital is what allows you to get into that next one. I don't know. What do you guys kind of see?
I spot on agree with that. I have a big question that I think everybody should ask themselves in all areas of life, but let's just use this for property investing. What would you prefer, comfort or freedom? And comfort, you can have you can get comfort pretty fast in the short term, right? Like, be more comfortable, basically, and it's just basically how your mind operates. You might feel more comfortable because you've got an extra $100, or your portfolio is like you buy property and that's neutral, and it's not like losing $2,000 a year or $5,000 a year.
Yeah.
That's fine because you're comfortable. But what if your property was losing $5,000 a year, but it's in a high capital growth area where you're getting 8% to 10% growth, and you're getting, say, 60 to 70 or maybe 80% equity in that year, and you take off the $5,000 of the comfort, and you still got like, maybe 55 to 75K in capital growth.
Yeah.
And that capital is actually in the long run, like if you're playing a chess game, like you mentioned, like don't, like in a property portfolio, play a chess game is like, how do you buy the right one that's going to able to buy the next one? You play the chess game and you go for freedom in the long term, but sacrifice comfort. Like this is why people fail, is because we've got so much attention on like, I need this now, because they're going into investing from a place of fear and stress versus a place of like, I can do this long term with a huge time horizon, set the bar super low, and unlock freedom. And most people's goal, I believe, is freedom through investing. But to get it now, it's very, very hard to get, like at a click of a finger.
Anything good is worth your time. Like, and that's the thing I've learned too, is like, you got to put the hard work in. Like, you can't just outsource it. That's where people are going wrong, was they're just looking at, there's so many distractions and they're wanting that short-term dopamine hit because that's what they've been raised on. And I guess there's also remember Joe, probably back in the day, we sound like we're old. We're not that old, mate. But like, there was that, you buy 200 properties and it's all cash flow positive, and you're just going one after the other. And I hear those strategies coming through a lot less lately, because I think people come to the realization through sharing of knowledge is that having 50 properties is 50 headaches as well. So after that cash flow, it's like, is that really what you want?
So if anyone doesn't know what Sam's talking about, he's talking about a guy named Steve McKnight, who is pretty much foundational property. Read every one of his books. He is an absolute wizard in this industry. And his goal was to buy 200 properties in 2.5 years or something. And he did exactly that. Fast forward to 2024, we had an interview with him on our show. And we're like, so what's Steve McKnight up to now? And he's like, I own 4 properties. That's it. So what he's done is he's built a portfolio. So there's kind of 3 phases of a portfolio. There's accumulation, there's consolidation, and then there's cash flow. Steve started with accumulating those 200 assets. Then he sold them down to consolidate them, and then he converted that capital into cash flow. And we did that's incredibly powerful. Like, you see the guy, 200, I'm very special. But he's like, no, 4. That's it. That's all I've got. I've got 4 commercial properties that give me high cash flow yield, because that's what I need. I don't care about the flex number. He wrote the book about it when he had the flex number. But now he's kind of transitioned into that next phase, and it doesn't really matter. Like, one of the things I think people need to, so my buyer's agency, we don't buy commercial property, but it's in every single one of the plans. Well, not always, not every single one, but it becomes a part of the strategy. So I think that people need to consider that in the back of their mind, that maybe commercial might be the higher cash flow position to help you get into that next one and that next one to build it out. But you don't start there, because you need a lot more capital. The capital growth isn't as big. But the question, another interview that we had with an awesome guy. His name's Richard Morgan. He's a mortgage broker in Sydney. And he's like, we did this development and this, and we built the capital. And then I was like, wait, why aren't you doing commercial? He's like, no, at any one point in time, I'm, in my 40s or whatever it was, I'm not retiring anytime soon. So why would I buy commercial right now and only compound at a 6% rate, right? Because it's a 6% rate of return around that, but not factoring in with the residential space, if he buys it well, he can compound at 13%. So in 10 years' time, why would I want to compound at 6% when I can then double my money by that time of 10 years' time, sell down that portfolio, and then convert that into the cash flow? And that made me stop and think and be like, actually, it really doesn't matter what the asset is. It's the capital return that you're getting, and then when you need a transition, you make that transition.
I love that. You just preempted the answer to my question.
Oh yeah,
we didn't give Joe the questions prior to this, by the way.
Yeah,
so.
he doesn't
I'm
need
trying to catch him out.
He's already got this. He's already got the knowledge. Like, come on. He's
what were you going to say?
trying to make it easier on himself. It's like, just be natural. You've got this. Like, he's a lord already. So with that, Joe, I was going to ask you, like, all right, so you put, you buy resis, right? But and not commercial. Maybe in the future you guys might do that as an agency. But you do. This is so amazing because you think about, all right, they're going to use our service for a certain period buying residential, but it still include commercial in their property portfolio. I was going to ask, like, after how many properties in resi do you move to commercial, which is not that can be a decent question, right? But a better question is, like, what stage in your investing journey, based on where you're at personally, maybe age-wise, retirement-wise, whatever it is, should you move to commercial? And it sounds like once you want to go from higher growth to scale back on growth, like maybe 10 to 13% in resi, and then moving back in, and then move that into commercial, right? Like, I guess it could be like how many.
When you get to that capital point, right? So right now, I don't know if you guys are following along. So Oz Property Investors on Facebook, just AUS Property Investors, we're building a passive income to $150,000 per year. And we've actually sharing absolutely everything. So in the past 6 months, we've bought 4 properties and we're sharing all the details of them. So we've got a 3 into 4 bedroom conversion that we bought in Victoria. We have a block of units that we bought in Geelong in Victoria. We bought a Townsville subdividable 1 into 2 property that's a corner block that allow us to split it off. And then the third one is a big renovation that we're in the process of doing right now. And we're just showing all the numbers. So we bought the Geelong unit for 1.15 million, big amount. Like it's not small money.
Good deal by all the sounds of it, though. You got to rip up.
Oh, mate, that one we're going to strata subdivide it, which will allow us to create $500,000 worth of value at any one time. But we're not doing that right now because that's not a part of the strategy. We're not in the consolidation phase. We're in the accumulation phase. So what I like to call it is like frozen equity. So you guys don't have to be an expert in subdivision. You don't have to be an expert in development. You don't even have to be an expert in renovation. But if you can just change the way that you view things as like, okay, future Joe can have that and deal with that. So what I do is I buy sites that have subdivision potential. By just calling up the there's a little bit more to it, but just call up the council, understand the rules a little bit, and you can then say, great, well, this is actually a subdividable lot. You don't need to be a development expert. But in 10 years' time, as you grow as an investor, you'll get more comfortable. You'll be able to run those developments. And I'm running developments. I've just finished a development in South Australia. But you get to that point and you build up to it, and then you create that value and unlock it. But if you don't freeze it in the beginning, if you just buy, like pretty isn't profit. If you buy the prettiest property on a 400 square meter block that's a 4-bed, 2-bath in an area that doesn't have high demand, you're just sitting on something and you're waiting for the market to do it. If you can create capital growth and value, that's a far better way to go. And then you can unlock that or unfreeze that equity whenever you need it.
Absolutely.
Question.
Sorry. Went off on
I
one.
love the passion. I love it. That's good.
No,
you can see that you're into a lot you actually enjoy doing, which is probably the challenge for most people in this world. So well done. Where's the sweet spot? Let's get down to the nitty gritty. Yeah, it's not the elephant in the room, but it's like for investors, right? We talk about capital growth and cash flow. I kind of want to circle back to that because you provide a lot of value there. Is there somewhat of a sweet spot? Because there's always that balance. And is it? It's always a moving target. And classic old Steve Policey, he drops the case by case comment a lot. But like in this current market, is it sort of sit between that 3.5 to sort of 6% yield from that, say, 500 to 800K purchase price, or?
For an 800, for a 600 to 800K purchase, it would be around that 3.8 8% yield if you were going into some of the more like bottom of the like warm spots. So there's like a hot spot and a warm spot, right? This was these phrases was coined by the guys over at H-Tag, and I really enjoy it because it kind of like it just says what it is. It's like Townsville right now, a very hot spot. There is a lot of demand. It's going to be very hard to get into the market. We were buying there 3 years ago when we saw the warm spot. We saw it starting to heat up, and so far, we were buying $320,000 properties, and the yields were at 6.5%. So one thing to mention for people, and this is the thing about education that's been. So I've seen a couple of courses out there and things where they've made it 5 years ago. Well, the market's fundamentally shifts. We've just gone through the largest boom in history. The market has changed, and you have to adjust to that. So these 6% yields that you could get, that we were getting, you just can't get anymore. So I think the big shift that we're going to see is there's just not going to be as much cash flow opportunities out there, which is why it's more important for you to think, how can I add value to boost that cash flow, be it adding an extra room to create a fourth bedroom, adding a granny flat, which is not as hard as you think, or subdividing off, or creating or buying like rooming house assets, or creating one. But that's the biggest shift we're going to see in the next couple of years is it's moving away from that cash flow, and people have to take a little bit of hit on the cash flow side of things to get that capital growth. I don't know. How do you guys feel about it? How are you seeing it? How do you think about it?
Mate, you raise a really good point. And this goes back to life too. Jaryd and I like to get a little bit philosophical here on the Property Pals Australia podcast.
Nice.
But basically, the only constant in this world is change. And one key change that I'm seeing is, it's like there was that flight towards cash flow and yields are compressing. And you got to be able to be flexible. And I guess that's the value of a buyer's agent, which we're going to talk about later on in the pod. Understanding what market you're actually buying into and not living in past strategies is important. Yeah. I do think the value add is really key from a client perspective. Obviously, they've got to understand what that sort of entails, and project managing things interstate. It's not the hardest thing to do in the world, but are you like with your buyer's agency, Property Principles? Are you sort of plugging in types of project management in that, or are you just guiding them through to the right people?
Yeah, it's more of a guidance. I mean, this thing, what I'm talking about is more of like a frozen equity strategy. So you don't need to rent it, like get an ugly duckling that's perfectly rentable as is. We just bought a renovation project. I actually don't recommend people renovate in this market right now.
I agree. I was about to mention this. That's like when you ask, what are you seeing? I'm like, it's great to just buy that frozen equity and just wait. If anything, this market is forcing people. It's really good to answer your question, Joe. It's forcing people to become better investors by not going for the quick cash grab because it's not as available anymore. And then they build their portfolio on the foundation of like, okay, we have to buy either frozen equity or high capital growth. And then once they become a bit more sophisticated, it's like, now we can take a little bit more cash and that can increase our borrowing capacity maybe to buy something bigger or better or build the portfolio out.
Yeah.
But I totally agree with you. Like that's
the thing. So one of my first deals, I paid $280,000 for it, and I did a $20,000 renovation, and it was revalued at $360,000. Congratulations, go Joe! I put $1 in, and I got $3 out. But the problem is now trades have gotten incredibly expensive. Property has gotten very expensive. Supply is very difficult for trades and people. So now that dollar, and also as properties have gotten more expensive, the value compresses of renovations. So whereas an ugly house, when there's 1,000 properties on the market and then 500 are ugly and 500 of them aren't, that's fine. There's going to be a big disparity in prices between the hot ones and the not ones. But what's happening is the ugly people are like, oh, well, I still need to get into this market, so I'm happy to take an ugly duckling. So now the value is literally the cost of just the materials. Not even the trades to do it. So you would buy it $30,000 under market as if it was fully renovated, and you would have to put in $30,000 just for the bathroom, but that still doesn't pay for the $20,000 worth of trades. So don't go out there doing renovations is I mean, I don't want that to be my tagline because we do minor renos and stuff if it stacks up. But yeah, I wouldn't say,
you mean, though, like not
yeah.
right now
So
in this market. Yeah.
I mean, this is the problem. I'm doing one now, right? I'm doing a full scale renovation. I got 2 trade quotes for it. One was $100,000 and another one was $89,000 for a 3-bed, 2-bath property that does not need much work at all, and it's like ridiculous.
Yeah.
But it's now I'm putting $1 in and I'm getting $1.50 back because I want to own a property. I want the ugliest property. I want the ugly property on the best street. So I had to buy that. We bought it really well and we got the discount on the way in. But it's to own that place in that area rather than extracting the value from the reno.
I love that explanation, and I think people, should consider their time here and what their hourly wage would be if, like, you put in $1 to get $3 when you first started. What's your wage per hour then? And then what is it now? And then you realize, like, well, okay, what if I just leave that for however long? 5 years, and then materials come down, for example, if it does, what would your wage be then roughly? And you're looking at what your ROI is based on time. I think that's a really, really critical thing for people to ask. And I also want to add, like, we're talking about resis now. I want to come back to the resi versus commercial. What do you like for somebody starting completely from scratch when you're in a strategy? Just so the listeners can understand, what sort of stage in their portfolio do you say this is when you could possibly move to commercial from resi? Like, is there a number of properties? Is it amount invested? Is it based purely on when they want to retire and then go from high growth to scaling back a bit? How does it look?
It really depends on them, right? Like on what their ultimate goal is. Like this Oz property portfolio, we've bought 4 properties. The total value, I'll bring it up. I mean, I probably won't share it because I imagine I can't share.
Whilst you bring that up, what is the goal for the portfolio? Is 150K passive? Is that the goal to get that as fast as possible? Or is it just to get there in a shorter period, like a longer period of time or a shorter period of time? Because what's the goal for it?
Well, the goal is to show people what's possible, really, and it's an excuse. So I've been buying very heavily for a lot of clients and absolutely killing it. Like 2024, the average return for our client, the average return for Australia was 6%. Our company got 21.6% return for clients. So we're that like 16% difference for clients, and it's like, guys, this is possible. But the stupid thing is, over the past couple of years, I haven't been buying myself properties. And I'm like, damn, I need to stop. I need to focus on the clients, which I've been doing. But also we need to start, showing some portfolio. I already have a portfolio separate to the Oz property portfolio. So does Jeff. So we have our own kind of multi-million-dollar property portfolios aside. But this one's like, cool. Now we could just show you all the numbers and all the. Can I share my screen in this thing? Is that possible?
Yeah, man, you can.
Okay. I'll just show. Okay, let's try this, and you guys can see. Do people watch this, or is it more of a podcast?
Yeah, it's on YouTube. So, guys, if you're listening now, just go and suss it out on YouTube and see the screen that Joe's.
These are the real. This is what I love, and it's what I was thinking. What would I want as a property investor that I don't see out there in the world? So you guys can see that we purchased the Victoria 3 into 4. Townsville 435, Melbourne full reno 530, and then the unit block for 1.15. So after all the renovations, we've now been revalued at 660. We've now had the hot market Townsville go to 495. The Melbourne full renovation, when it's completed, because we're in the process of doing it, it'll be around about 650. And then the units got revalued at 1.2. So we, in the last 6 months, purchased this many properties. We already have $419,000 worth of value created on top of this. Like, this is what happens when you strategically go out there and purchase the right properties at the right time in the right market. The other thing that I want to point to people is you have a choice as an investor to go after, the hot markets or the warm markets. We were buying heavily in WA and we rode the full wave of the property market. that's what, as you can see, my opinion is where Victoria is right now. Victoria is at the bottom of the market based on all of the data that I'm seeing and all of the research that we've done. We wanted Townsville as a hot market to get some quick equity boost, which is working, but all of our money is heavily invested into the into the Victorian market.
Oh,
So
wait,
we-
wait. Geelong market? Victorian market?
No,
Double
well,
down?
so the Geelong unit block, and then Victoria, like Melbourne, out of Melbourne, 40 minutes away from Melbourne type of thing.
I
But it's
was
all
trying to
possible. It's possible to
trying to
do
get the
this stuff, guys.
trying to get the secret sauce from where you're buying exactly today.
Go buy in
to share
Geelong,
with
and
us.
you're not going to be too upset.
Speaking
Just
of
go buy in all these areas that Joe just bought, and we'll just make sure his like case study
Pump it
becomes
up.
even bigger.
Yeah,
Pump it
yeah,
up, pump it up.
that's
And
one
also
thing
where
that
I
I-
bought and where Sam's bought too. You guys, WA.
Yeah.
So everybody go into WA and
Yeah.
Melbourne.
yeah, there's a few things I want to touch on there. Is obviously there's good, there's bad, and there's rubbish in every industry. I keep saying that, but also there's also be careful what you're listening to, because people have preconceived ideas. Because we get clients that are coming to us, and no doubt yourself, Joe. Like it's like, oh, I want to buy in Perth, and you're like, oh well, that horse was run, but they're on the back end of the hype, and there's a few different businesses too. They go in, they share their results, and then it's in their client's best interest for the retail to follow after, because it helps with that growth. They look better. You need to be smarter, and that's what goes back to what I was saying about doing the hard work on the way in. Or outsourcing that hard work to someone who actually knows what they're doing, aka Joe Tucker right here.
Yeah.
Hey, Property Principles, go for it.
Propertyprinciples.com.au.
Yeah, that'll work.
I'm just
and when you guys like, what's back what Sam's saying is like, when you go speak to a buyer's agent, is like they might have like a couple of areas based on your capital, and every time you make any investment in anything, you need to weigh up your opportunity cost, and you should do that between the areas.
Yeah, definitely. And also so back in the day, we're talking about the 200, you can't do 200 purchases like Steve McKnight did back in the day. So now more than ever, that first purchase needs to be bang on, so that second purchase can be bang on. Our borrowing capacity, there never used to be a borrowing capacity. It used to be cash and equity and cash flow, right? Those were the two vials. We've now had to add borrowing ability and serviceability, because it's such a constraint that stops everyone. It hits the glass ceiling, they call it. So if you want to find a buyer's agent, these are the actual questions that we have on the group, and literally we've got hundreds of people replying back. Great, just does a shark buyer's agent. So if you guys use us and we can actually help you out, amazing. If we can't, then whatever's going to be best for you. But whatever doesn't get you caught with a dodgy dingo is the aim. So how are you getting paid? These are the questions you need to ask buyer's agents. How are you getting paid? What kickbacks, referrals, and commissions do you get from anybody? So if they're getting a commission from the mortgage broker, they're getting a commission from the conveyancer, like, are they a team vetted, or are the team actually just getting kickbacks and paying them? So none of the team that I have are getting any kickbacks, referrals, or commissions. And also, you don't have to blanket ask these ones. Like, you can have fun with it. Like, go rapid fire, right? Like, how many have you been? How long have you been personally investing? Like, what is your investment philosophy and your views? Oh, I like to buy just house and land packages in areas in the middle of nowhere and townhouses and stuff. That might not be the strategy that works for you. What sort of properties do you own? Because is that different to what they're actually buying you? How many clients are you currently working with? So we have a cap on how many clients that we work with, because like we can't work with 1,000 clients, because this is the challenge that I see with a lot of large scale buyers agency. I run Australia's largest property investment community in the whole of Australia. At any one time, we could turn that into some bullshit marketing spin, and then I could be one of the largest buyers agents. But the problem is there's not that many deals out there. Like, you can't churn through. Like, you get 1,000 clients, you then have 1,000 properties, and then the quality has to drop for you to pump it through the system. So it's very difficult to do that. So that's one thing is something to be aware of. Like, if you're going with someone that's, absolutely massive buyers agency, just make sure that, do your research. Another key point, I believe this to be true about this area. Great. When was the last time you had boots on the ground? when were you in that area? So that's one of the things we do. Every single area that we buy in, I have gone to myself. We built the hypothesis on the computer, believing this to be true, but then we got on I got off my ass and flew to that area, met the real estate agents, identified the hot spots, identified the areas of the not spots. So do that as well. When was the last time you were there? And then what else is another good one?
Another good one I would add is what sort of results, like past results, have you gotten for clients? That's the average, not just your best results you've gotten for one person.
Yeah, it's a very good
good
question.
You mentioned your average, of 2024. It's not like I'm sure there was areas that grew 30% or more or whatever, but what's the average?
Yeah, I can't talk about. Like the thing is, if I talk, like there's literally one that I'm just looking at 49.5% growth. Like,
and then somebody calls you up, is like, I want this or nothing else. And you're like, come on, dude.
So it definitely takes the average. It takes the average up, but you just got to. Also, another good one to ask is, hey, can I have a discount? Because like, if they're willing, yes, sure, no, look, I don't want discounts. Fine. Like, are they actually going to negotiate well with you? Like, if they can't negotiate with you, they're going to be rubbish at negotiating with real estate agents. So
I like
always,
that's
a little hack.
Everything's negotiable as well. Everything.
No, you don't ask, you don't get, but that's also understanding the value you've got. And I think the way that you've even built your buyer's agent, right? Like, you're ringing true in that there are a handful of deals, and also as you scale, you lose that quality with quality control as well. Like, how big would be how big is Property Principles these days?
Well, we're doing really well. We've got some incredible people. The hard part is, as to scale, is finding the right people to do it. So like, so we have three buyers agents in our business, and then when we hit, then we max out on 20 clients. So as soon as we hit 20 clients, we then say, okay, great, let's chill out for a little bit, because we've got to serve the clients that we've got. So when it hits that, depending on the brief as well, so like 16 to 20 clients is kind of where we tap it out. But like Kelly, for instance, she's done 22 renovations, 9 joint ventures, and 2 developments. You've got to she's just going out there and crushing it. It's what you want.
Good deals. We could probably chat all day. I think, Jaryd, that was one of the questions. What makes a good buyer's agent? And obviously we've covered a fair bit off on that. Another thing, mindful of time too, but going back to the changes, like I'm seeing one of the big changes I'm seeing now is the access to location research and data, and especially that short-term data, and the rise of buyer's agents. I'm seeing markets become more volatile. So it just doubles down on the importance of actually doing the hard work. But I mean, what do you think in that realm? Like, everyone's trying to get that, monthly subscription and piling into these locations, and there's like, what risks are you sort of foreseeing for the next couple of years?
Well, if you just follow everyone, you'll get everyone else's results, right? You've got to think for yourself. Like, you can't just go ahead and get one subscription and think, oh, cool, yeah, I'll just do that. I'll just do what everyone else is doing, because there's I'm seeing some interesting stuff going on in like Northern Territory, right? The data doesn't make sense for Northern Territory, but I'm looking at some people that are jumping in there. I'm like, why are you going in there? It doesn't stack up. But just do your own research. Don't just rely on one platform as well for your data. There are some really good platforms, like the hashtag platform is really, really good. That'll give you like high level macro understanding. But yeah, I think that data's key, but I don't know how to say it. Like,
get on the plane as well.
Also the difference of a quality property. Like, if you can buy in a property market at $500,000, you can get it $20,000 below market value. That's a large. What's that? That's a large percentage of what the purchase price is. And then it's like, well, you've just made 5-10% on the way in. Great. Then that market. Buying that property in that market is actually better serving for you than going where all the hot stuff is. So like Townsville, for instance, if you're buying in Townsville right now, you're going to be overpaying for stuff if you're not doing it correctly. So it's like, cool, you could buy there, but you're going to be paying $20,000, $30,000 more. Why don't you go to an area that's easier to buy in, that you can get a better discount, because that discount is actually going to serve you over the long term better, because it is also going to give you the equity that you need to then go for the next one and then ride that capital growth wave from the bottom.
It comes back to what I was saying before, is like, before you make any investment, the first time, like every single investment, each time you make one, is you need to assess your opportunity cost between areas.
Yep.
Like it's, and between, you know, if you're not investing in property, investing whatever it is, assess your opportunity cost between all the things. Like,
yeah, your goal as an investor is to buy the best property in the best location at the best price for your buyer brief. And that buyer brief is what dictates everything else. What's a good property for you, Sam, and what's a good property for you, Jaryd, is completely different to what's good for me. So it's not just about, hey, where's the next hot spot? No, it's about what is going to plug into my portfolio that allows me to steamroll to the next one. Because, you know, it might be buying a Bondi, you know, McMansion, but we all don't have $3 million, $10 million to do that. So that's not going to be suitable for you. It may be the best growth asset all of a sudden, but yeah, you got to be strategic about these things now.
Absolutely, and think about the, you know, how you want your portfolio to be in 2 to 3 acquisitions time as well.
Yeah,
love it, Joe. Thanks so much for coming on.
Yeah, thanks for having me, boys. It's good to catch up with you. We got to we got to have a bintang or whatever the hell they serve in Bali. What are they? Is it bintang? It is, isn't it?
Yeah, bintang.
Oh, come on. You're working too hard, mate. You got to get a Bali, bintang. Just chill out.
We'll get you a bintang singlet when you come over as well. True Aussie Bogan style.
That's the real acquisition I want.
Yeah.
Anyway, Joe Tucker, thanks very much, mate. Director of Property Principals Buyers Agency, so go check that out. And also jump on to the Oz Property Investors Facebook page. Obviously, you're the co-host there with Jeff Miles. We're getting Jeff on in a couple of weeks. Just got to organise that with him. I'm really keen to pick his brain about location research and what he's learned as well.
He's a switched on boy. We actually I don't know if you even know this, Sam, we just created a course that talks about more of the fundamental stuff that we're just talking about now. So it's called levelupproperty.com.au. We're only taking 20 people on for this first round, so you may have missed it by the time this goes live, but do register your interest if you are interested about learning this stuff. It's pretty, it makes a difference.
We'll chuck a link in the description below for sure. And just to double down on that, mate, it's not going to be. Is it evergreen content? It's not going to be irrelevant in 5 years, like some of the strategies that are out there.
No, exactly. It'll be evergreen, and then if the thing is also when it changes, you got to change with it. We're buying in the market. I'm just saying this is what is working right now, and I'll teach you what is working right now, and then when it changes, we'll change it with it. Because that's what you have to do as an investor. You can't like buy in and expect to know what's happening in 10 years' time. You got to change.
Stop stuffing around and level up.
As your business should change as well to suit your clients. Like otherwise your business becomes non-existent. Like just set and forget is just the worst strategy ever.
Awesome. Love it, boys. Catch you.
Cheers, Joe. See you on the next one.
Bye.